Hello everyone, this is Oil and Gas Investor. Today we break down the first quarter 2026 results of the largest U.S. integrated oil and natural gas companies, ExxonMobil and Chevron. Before we begin, like the video and subscribe so you don't miss the key moves driving oil and gas markets. Let's start with the key takeaway. First quarter results for both companies came in weak. Higher oil prices weighed heavily on refining margins. As to ExxonMobil, the downstream segment reported a loss of $556 million in the first quarter, compared to a profit of $827 million a year earlier. Chevron's refining segment also moved into negative territory, posting a loss of $465 million versus a profit of $492 million in the first quarter of 2025. As shown in the table, both operating cash flow and adjusted earnings per share declined sharply in the first quarter. Results were negatively impacted by Winter Storm Fern in the United States, as well as lower production in the Middle East and Kazakhstan. We highlight that these headwinds are largely temporary. However, it is important to note a broader trend. Adjusted earnings per share have been declining for more than 3 years. Net debt of both ExxonMobil and Chevron continued to increase at a rapid pace in the first quarter, partly driven by seasonal working capital build. That said, net debt has been rising for 4 consecutive years, primarily due to aggressive share buybacks. In 2025, ExxonMobil spent $20 billion on buybacks, while net debt increased by $14 billion. Chevron repurchased $12 billion of shares, with net debt rising by $17 billion over the same period. Despite this, in the first quarter of 2026, ExxonMobil allocated $4.9 billion to buybacks, while Chevron spent $2.6 billion. So why did companies continue large-scale buybacks despite rising leverage, weakening financial performance, and elevated share prices? The answer is straightforward: management incentives. At Chevron, shares issued for stock-based compensation surged to $1.2 billion in the first quarter, compared to just $0.2 billion a year earlier. ExxonMobil did not disclose this figure in its first quarter release, but the underlying incentives are clearly similar. In our view, both stocks appear significantly overbought, even after correcting more than 10% from their 2026 highs. Like and subscribe to stay ahead of the most important moves in oil and natural gas markets.